Is it true that they charge black people more interest rates than the whites? And is it true that your interest rate is also calculated based on where you live, and also based on your age and stuff like that?
People go out on social media, post these fancy cars. I got a expensive car from my boo, my bae, my what. SARS is out there actually monitoring these things, hey? And people get themselves in trouble by simply trying to floss and post things. Because what happens is, according to law, if you get a Range Rover, whoever gave you that has to pay 20% of its value as donations tax. A lot of people have gotten those car financing, vehicle financing with a balloon payment. And they don't even understand the implications of having that money at the end of the term for the balloon payment. To them, it's a cheaper premium. And sometimes our industry is also a bit suspect, because some of these providers, they just want to sell you a car. They don't really explain to you the ins and outs of things like balloon payments. And some people don't even understand.
Hi everybody. So a couple of weeks we were talking about money, right? And everybody loves money. If you think diamonds are a girl's best friend, then you've got it all worked out wrong, because money is a girl's best friend. But today we are actually going to talk about money, and we have a guest. He's joining us now. Thank you so much, Raymond, for joining us. Hi Raymond, how are you?
I'm good, thanks, Mahlatse. How are you?
I'm good, thank you.
Awesome.
So please tell our audience about yourself.
So my name is Raymond Madombwe. I'm a financial planner. I assist people with their financial goals and achieving financial freedom. That's what I do.
Wow, that's amazing. That's some really, really good stuff, because we definitely need that, we need those kind of planning, because we never stick to our budgets for some reason. People actually do struggle a lot.
No, I agree with you 100%. I think it's just the way that the formal education system, no one really teaches you about what to do with money when you get to that point where you're now earning money. You have to figure it out, and I think that's a problem, because a lot of people, they end up drowning in debt, getting into other issues because they're not prepared for the money. So it's important to have these money conversations.
Yes, and you find also these, statistics online that look, or advices online that really, really look unrealistic, where they go like, you must save 30% of your salary, and I'm like, what do you mean? Because SARS already took it, so those kind of things as well, So yeah, so where is Raymond from?
I'm from Zimbabwe.
Okay.
Born in Zimbabwe, came to South Africa in 2007. Studied at Stellenbosch in Cape Town, crazy there. Then came to UJ to do my honors. Learned a bit about financial planning at these two universities.
Okay,
Yeah.
Okay, lovely. That's great. I'm also from UJ. I'm not sure if I did any crazy things there, but okay, guys. So we are gonna get into it. So first question: what are the most important financial habits to develop in your daily life?
I think the very most important one is budgeting. I think people take budgeting for granted. It's something that we don't really think about, because when the money comes in, I need to do A, B, C, D, E. But you need to have a roadmap before the money even comes in. Where is it going to go? Or what am I going to do with it? And a lot of the times, for saving especially, it's always best to automate it, if you get what I'm trying to say. Instead of you even trying to pay your money to a savings product, it's better for that money to just get deducted in your budget before you even touch it. Pay your future self. Not necessarily 30% as you put it. It all depends on obviously the person and what they can manage to do, but it's always important to put money aside for a rainy day, because they definitely do come.
Yeah, and they start becoming Haley days, because now it rains with ice. Those yeah. So
I agree with you.
How can listeners create a budget that works for them? How can they create that budget that you say they must create? So what roadmap, maybe for example, what roadmap are you using currently to budget for your money?
No, thank you. So what's important is to understand what your goals are. What am I trying to achieve in the short term, in a year, in the medium term, maybe in 5 years, in the long term, retirement, you know what I mean? And through your goals is when you actually figure out what to allocate to what, because we are all very different. There's never a one-size-fits-all solution when it comes to financial advice. We are very different, and we all have very, very different goals. And as a result of that, we always have to work through what we want to achieve. And to achieve that, you have to sit down with a financial planner like myself, where now I unpack my skills to help you achieve your goals that you're trying to get to.
So, do you think the financial planner career, there's enough people in the career to actually help? Do you think this is affordable? Can a basic person who earns probably the average salary actually afford a financial planner?
So that's interesting, actually. It's not really about how much you earn. I've met clients that earn plus 100K, and they don't have a medical aid. They don't have any decent financial products. And when you try and talk to them, they're very arrogant. They don't want to have those financial products. So it's about seriousness. It's not really about how much you earn. It's about, are you committed to achieving your goals? Are you really ready to listen to me when I give you advice that, listen, you need to plan for A, B, C, D. You need to do A, B, C, D to get to where you need to get to. And that's when, obviously, a financial planner will add value for you, if you know where I'm coming from.
I get where you're coming from. But in terms of the medical aid stuff, I mean, that's debatable because we live in a country where there's free healthcare, even though it's probably not the best. So maybe that could be why some people are skeptical to getting medical aids. But I'm not sure. Maybe they just trust God and they'll be fine until the end of time.
So let's understand one thing. We all have different viewpoints and we come from different backgrounds, right? So if you go into these boutique restaurants, you're going to these nice, very expensive places, do you really want to go to a budget hospital? I'll give you an example. Is that what you're saying, that you're prepared to do that?
You want to live.
No, but remember, you've got a standard you're accustomed to. You know what I mean? So if you're someone that's obviously got your kids in private school, for example, and it shows you that you're willing to pay that premium price to get a service that obviously gives you value from your perspective. So now to say, okay, now I'm gonna try and save money for my own healthcare, I find that a bit confusing because you want premium things, but you're not prioritizing premium health for yourself. It doesn't kind of make sense to me.
I actually agree because, with healthcare, there's a lot of packages that you can actually get. There's medical insurance, which is way cheaper than actually
100%.
medical aid. And the medical insurance normally have unlimited, consultations with the GP,
Yeah, 100%.
and you get the prescriptions and you can
Yes,
get telephonic help when you need it, and you can get scripts and all of that. So, and you find that maybe you need to top up with $100 or even less for your medicine. So I do think you're right in that regard. It's a bit... it does not make sense to actually be there.
You can't be in a queue waiting to get service.
And you
sometimes
parked a Porsche outside.
Exactly. Waiting there.
Oh my word! And then in terms of while we're still talking, what are some of the common financial mistakes people make, and how can they avoid them? Besides not getting medical aid when you can afford one.
So I think the first mistake is not planning. You don't have a roadmap. It's like literally you get into a game, you want to play soccer, whatever it is, whatever sport. You don't have a plan. You just get in there and you just start randomly doing stuff. It doesn't work. It's never going to work. It's always important to have a roadmap, a plan of, all right, here I am. I've started working. I'm making a bit of money. What do I want to do? Where do I want to go? What's my plan to get there? You know what I mean? And that's when the financial products are coming in to obviously help you achieve those goals that you have.
But would you argue that maybe sometimes not the planning, maybe it's like sticking to the plan? Because, some people have plans and they just never pan through, because you plan, yes, I'm going to save 5,000 Rand this month, and things just keep happening and you are unable to save 5,000 Rand that month. So what is that? How can, what advice would you give them to keep to that discipline, in terms of the planning and keeping up to the plan?
Oh, thank you for that question. So remember, that's why I was saying it's important to sit down with a financial planner. So we are like your coach, your financial coach, right? We are there to assist you achieve your goals. We have tools that we have obviously acquired over the years. One important one is understanding the tax laws, understanding obviously the financial products, and all these things that we give you to be able to actually achieve your goals. You know what I mean? And that's where we come in. That's our value add. And you have situations where people end up getting themselves into very sticky waters, not because they want to, but because they just don't have the tools necessary to be able to manage their goals. And like you said, if it's difficult to save 5,000 Rand, that's why I spoke about automation. We can create a situation where as soon as the salary hits the account, we take the savings portion, we take the 5K that you're talking about, that already goes to savings. So they don't get to a point where they now can't do it because they don't have to do it manually. We automate the processes. And that's the one thing we've actually realized as financial planners. A lot of the times people fail because they want to do it manually. And we create the systems to automate things so that people just understand that every month money is going to come out of my account. It's going to this savings product, if you get what I'm trying to say.
So also one thing that I've seen, is some of us have that misconception that, financial planners could be expensive. So can you speak to that? Can you speak to, what exactly is a financial, there's like private financial planner and there's other financial planners. So someone who can't afford a private financial planner, what other packages maybe they can look at in another. I'm not sure if I'm making sense.
Okay, no, you are making sense. So for us as financial planners, obviously sometimes we all want the premium clients, the high net worth earners, ultra high net worth. That's what we're obviously looking for. But truth be told, not everyone gets there. They start somewhere. You know what I mean? And as a result, we actually end up cross-subsidizing. Like the high net worth clients end up making it possible to create time for the lower end clients. So we don't really have a ballpark figure of saying that we can't take anyone who earns this or that, simply because you never know who that person can become in future. And it's important to actually arm them with the tools that they require, because that person that's earning 10K even can end up earning 100K in 5 years. Very possible if they get the right tools and they understand obviously how to be able to manage their finances and achieve their goals, which is what's important. They'll get more value and they'll actually be able to achieve their goals.
Yeah, so actually, that's as audience, as you've heard, that you can actually get a financial advisor regardless of who you are. You just have to, knock on a couple of doors and you'll definitely find your person who's going to help you, because in future, if you learn how to use your finances with the little that you have, you can actually make more out of it and you can manage more when it actually comes your way. Because you find that what the things I've seen on the internet as well that have been going around is that when you have money, normally, when you get a certain amount of money, you use it, all of it, with everything it covers. And then when you get more money, you feel the need to use it in more stuff. You don't feel the need to invest it. You don't feel the need to save it. You just feel the need to fill it up. So you find that, if someone was living in a proper house and then now they're earning a little bit more, they get a bigger house. For some reason, as if the proper house was not enough, So those are some of the, financial habits that people have. But how can people actually, like you said, automation is one of the key things that you teach to people in terms of, when you get that money, let it go away, let it go somewhere to those, what other ways are there? What other smart investment strategies are there, especially for beginners? Because if you learn this at the beginning, it's easier than learning it at 100,000. Because if I haven't been paying medical aid from a 30 grand salary, I'm not going to pay it at 200 rand.
I agree with you there. No, I think the other important thing is discipline. You'd find a lot of the times, I'll give you an example of shares. They go up and down. You know what I mean? Sometimes people panic because they're reading a newspaper article that such and such company, the share price has dropped. And they think, oh, wow, my portfolio has probably lost value. Yet it's temporary, you know what I mean? That's the way shares are. They do go up and down based on obviously some bad news or some other development that obviously lowers the price. And if you lack the discipline, you just panic and sell at the bottom instead of holding because you never know, in a year or so, that same share could be probably double the price, you know what I mean? So discipline is another very important one. I think automation gives you a cheat or a hack to get discipline. But I think the main fundamental thing there is having the discipline to actually, number one, seek out someone who actually knows how to manage money, which is a financial planner like myself. And from there, listen to them and stick to the plan, because we give you a plan as a roadmap that you need to do A, B, C, D to be able to get to where you want to go. And if you actually have the discipline and you follow the plan, then you should be able to get financial prosperity for yourself.
Wow, beautiful stuff. Guys, are you listening? We are bringing you information, exclusive information here at Set Podcast. And also there's a statistic that I read that over 50% of South Africans do not have a retirement plan.
Yes, that's very true, actually.
So I think it's over 50%. 50% is not the exact number, so over plus 50% of South Africans do not actually have that. And, it also puts pressure on, those grants that are there for pensioners because people did not plan for them. And I'm not sure what the qualification, criteria is in terms of that. So how would you advise for someone to start saving for their retirement?
So saving for retirement is actually very important. I think as an industry, we've really tried to emphasize it. And even the government has come in and said, whatever you save, we're going to give you an incentive that it's tax deductible, meaning today you're paying less tax just putting money aside for your own retirement. So the government is actually coming in to give you incentives to be able to have a comfortable retirement. Why do they do that? Because then they know you're going to obviously, if you're not financially secure, you obviously come back and the government will have to take care of you. So they really don't want to do that. So they're creating incentives for you to be able to actually save for retirement.
So if you took a retirement fund or something, you pay less tax?
Yes, you do. Today you pay less tax because then from your income, whatever you're contributing to the retirement fund, subject to some limits, it will come off your gross income, meaning you actually have less to declare as income for your tax.
But are you talking about, companies that give those retirement benefits, or are you talking about if I went to a different company like Old Mutual and I took a retirement plan, because that would be taken off my banking?
So you can do it with the employer created funds, which is your pension and provident funds. You can also do it with your own personally created retirement annuity fund. So all of them, they're treated the same from a tax incentive point of view. Whatever you're saving for retirement, you're going to have a saving. And it's not even just for retirement. Whatever you're also saving, you're contributing to a medical aid. It's also deductible for tax as well. So the government is actually creating incentives for you to be financially smart and deducting tax from these products that you get that will assist you.
So in other words, that means if I had a retirement annuity, right? Yes. And when I file my taxes, I have to also file that I have a retirement annuity with those certificates that they sent, I believe. And then that's when 100%. I get it back with the returns. Okay, because that's what I was trying to actually understand.
If I'm getting it correct, are you saying that if you have a retirement plan, the amount that you contribute to that plan gets deducted from your income before tax, and then that's what goes in there, and then your taxable income is then whatever income you have less the retirement amount.
Okay, yeah, exactly. Let me just give you an example. Let's just say you're earning 500,000 rand a year, right?
Yeah.
And you contribute 100,000 for retirement, right? So what you're going to be taxed on is the 500,000 less 100,000 you've contributed. So your taxable income will be 400,000 instead of 500,000. So meaning you will pay less tax simply because you're contributing for retirement for yourself.
Oh, and also that adds up with the medical aid as well. Is that the same thing?
The medical aid is deducted straight from the tax that is due. It's slightly different. So medical aid has certain values that every year the Minister of Finance gives us the value that is going to place on the medical aid deduction. So whatever tax you have to pay, so after you've got the 400,000, you go through the tax tables, you figure out how much tax you're going to pay. From that, you do a direct deduction from the medical aid amount that they allow pay every year in the adjustments. So your tax payable will be reduced directly from your medical aid contributions. So you pay less. Let's just say from 400,000 you have to pay 80,000 tax for the year. And the medical aid, you've got yourself and 2-3 kids. So from 80,000 you might have a 15,000-20,000 deduction for just your medical aid contributions. You end up paying 65,000 or thereabouts.
Wow, actually, wow. I'm learning a lot. I think we need a chalkboard in here. Some of the things
I have a brilliant question here.
Okay.
Should I withdraw my 2-pot?
That's actually a very good one. I think what we need to realize is the power of compound interest. It's very important to realize that 100 Rand today might be worth way more than 100 Rand in 5, 10, especially 20 years. Because when I'm talking to my clients, right, and I am trying to invest their funds. I always tell them that from a base case, I want to do inflation plus 1%. So we're looking at minimum 7% investment returns every single year. That's the minimum. If things are well and the client is willing to take on more risk, because remember with investments now, the higher the risk, the higher the return. If you want to get a higher return, you have to get into high risk investments like shares, which I told you can go up and down. And once you get into those, you can target probably 15% a year in investment returns. So 15% a year for 100 Rand over 20 years is going to add up to a lot of money. Now, if you take it out using the two-pot, simply because I need money now, you're literally going to lose out on that growth you could have had over 15, 20 years, which could have been value. And I think financial providers, the insurance companies and others, they're looking at that as well. They're realizing people, probably it's a debt problem, right? So they've come up with some solutions. I actually had one provider introduce a product that they, instead of you going to a mashonisa to try and get money halfway through the month, you don't have any cash, they're willing to actually front some of your salary to you.
I've seen that. I think that's horrible. Isn't that horrible?
I'm so sorry. Can we go back, ne?
Right.
You see, when people were trending about two-pot,
Yeah.
now I was looking at dancing videos. So, what is please explain to me
Okay.
and everybody what is the two pots. I've seen it on the SARS portal.
Okay.
I don't seem to have it, but
You have it.
I don't.
I think you have it.
Maybe I have. I could have taken it out at the time, but anyway, I'm listening. So please
Okay, all right.
tell us.
So
anything.
what used to happen is you could only access your retirement fund when you're 55 years old, when you get to that point of retirement.
Okay.
Right? So somewhere along the way, government saw it was important that people were probably struggling or whatever it is. So they created a second pot, which is the savings pot. So you can access part of your retirement funds way before retirement, right? So you've built up a retirement fund and you feel that, okay, I need some cash, right? You can now access that cash directly from your retirement fund. It comes with very high tax payments for just withdrawing that amount for the pleasure, I'll put it that way. And also, like I said, it kills your future growth that you could have earned, the compound interest I'm talking about, the compound growth that you could have earned. Because remember, if you take out 25K now, that 25K, like I said, in 20 years could be probably 500,000 easily.
But I think you can correct me if I'm wrong also, but I think also the other issue that resulted in the two-pot system being implemented was that when you switch jobs, you could actually access your all of your retirement savings, and then so when people wanted to get, say you've been working for like 5 years, and then your retirement savings is built up to like 300K. People would then just resign from their jobs, or switch jobs, and then now you have access to that 300K, and then people start businesses and whatever using that money. But then now the two-pot system allows you to only get access to a percentage of that amount. While I think it's 80% or is it 70%? I'm not sure about the numbers, but the majority of your retirement is locked away until you're actually 55. And then you can access like the 30% once a year. You can make one withdrawal a year.
I'm so sorry. Just to also understand again. So this is for when the retirement benefit is part of the package that your employer offers you.
Yes.
Okay.
That's So let me just give you a response there. There's a minimum amount that you could completely withdraw in the past, right? So if you get to a certain limit and your retirement fund is lower than the limit, you could withdraw all of it. But if it goes past that cap, you could not withdraw that. You could only access that post-retirement.
Oh, really?
Or you could transfer it. Because remember, if it's employer funded, what they used to do is that you could actually transfer it from one retirement fund, because remember, you've changed jobs. So you're not on the same employer fund.
Yeah.
You can actually transfer that retirement fund to another kind of retirement fund that you own, right? So let's just say you've got a pension fund with your employer. You could actually transfer some of the process to your retirement annuity fund, for example. And that was, you could do that. And that was obviously, if it was below a certain figure, you could just cash all of it out. That was the initial understanding. But there was a change in the whole retirement fund industry. And that's when Two-Pot came into the picture. I think also as a result of the fact that I think government realized that the debt levels in this country are a bit too high. So maybe people might need access to their retirement funds before they get to retirement.
You need that money. and I think that it's the first 27K from your Two-Pot that's tax free, right? And then from then it's somewhere around 40%.
Yes.
That's taxed, which is
40%.
40%. That's close to half.
So what happens is there's two tables for SARS for retirement. There's the one where the first, if you retire, no more retirement age, the first 500K is tax free, right? But if you are now withdrawing, because now SARS is like, okay, you don't want to wait till retirement. And we remember, let's go back a little bit. I told you that, remember, part of your income is deductible. Whatever you contribute for retirement is tax deductible. So they've given you an incentive, and you don't want to wait for retirement. So they're gonna make it more punitive for you. So they have a separate table for people who want to withdraw, right? Which is what he's talking about, where it's no longer $500,000. That's tax free. It's 25,000 rand. That's tax free now. So that means anything over and above that is going to be at a higher tax rate for withdrawing.
Crazy.
So being impatient is actually expensive because you're going to pay more tax.
Guys, impatience does not pay. You need to be patient with your money. Wow, I think we're learning so much. I really think we should have bought a chalkboard or something in here. I really think this is a teaching moment for our audience. For me, on my side, I'm really not this clued up with finances. So hence, I wanted to have a financial planner on the podcast, also hear more about it. So, so this is a lot of information. Yes, AC?
Can I want a new phone. And there's a guy, Ekasi,
You're Tanda want to ask us.
Yeah. So he sells phones, and they're like, so I'm looking like maybe iPhone 15. He's probably going to sell it for around 10K or something like that, right?
Okay.
If I'm looking at that compared to a contract phone, is it worthwhile for me to go get a second-hand phone from Umjita Ekasi, or financially is it more is it a savior way to go and get a contract at MTN?
I mean, is your Kasi person trustable? I think.
Nah, the phone is going to be 100%. It's a phone, but a second hand.
So I think that question, the issue is, do you want a warranty or not? Because remember now, the formal guys, they give you a warranty. If anything happens, you can go back. They'll sort out your phone. Now, if you're in the States, you're not gonna. You can't come back. You can't come
He's
back.
my guy.
He's your guy. But then now he bought a faulty phone first, and he didn't even know, and he sold it to you. You see?
No. I mean, we have a handshake warranty. I think my warranty is like 3 weeks. You know what I'm saying? If in 3 weeks I'm not happy with the phone, I can bring it back like, man.
Guys, like I said, our ghost is the devil's advocate. I would suggest you take the financial planner's advice. Oh my God! But
I know a lot of people say that like a contract phone will increase your credit score, and then it just you look better when you're trying to talk to financial service providers. Like if you're trying to get a house loan or something, is that correct? Like,
yes, that's actually correct. So I think that's what really gets students, especially when they're straight out of university, they get a job and they have to build up their credit profile. They have to obviously get these clothing accounts, the phone accounts, all these products to be able to access the home loans and because they now have a credit record. But at times they end up drowning themselves in debt. I think that's where the risk is now. That you're trying to build a profile, but you are now overindulging, if you get where I'm coming from, and you end up having all these phones, the fancy phones. You've got you're taking clothes every 2-3 weeks, and now can't even keep up.
It sounds like you're saying I must go with guys.
No, not yet. Not yet. Guys, please. AC knows the guy. The guy you know at gas is not the guy AC knows, eh? His phone will work for an entire year. I take a gas. But if we take a gas, I don't know, and do not even test Johannesburg phones. Actually, we were getting into that, the debt management thing. Because, our youth is actually it's in a lot of debt at the moment. The debt percentages are so high. And, when you come out, I know the pressure of coming out of varsity and trying to build a credit score, because I was told you must get a credit card and you'll be good. And, when they get you the credit card, no shade to anybody who gives people credit cards. But, when they get you the credit card, they're like, no, you take the 50,000 and you use the money that you use. And then the rest of the money, you can leave it there. It won't go anywhere. And you end up using all of it. And you end up taking an extra 10K and then an extra 10K, and now you owe 70,000. And all over the years you've been paying them, they've been taking their interest. You've been taking your money back, and you keep paying them. And now you've paid them more interest in the debt that you took, or the loan that you took, and you are still paying them still, and the loan has not moved. So, what are the advices that you give to the youth in terms of trying to build up their credit score, and with such things happening?
Okay, thanks. No, I think, remember I mentioned the word discipline. I think that's where that word actually comes in. Just because you can access something doesn't mean you can afford it. I think that's very important to understand. Because being able to access it doesn't mean you can afford it. I'll give you another example. A lot of people have gotten those car financing, vehicle financing with a balloon payment. And they don't even understand the implications of having that money at the end of the term for the balloon payment. To them, it's a cheaper premium. And sometimes our industry is also a bit suspect, because some of these providers, they just want to sell you a car. They don't really explain to you the ins and outs of things like balloon payments. And some people don't even understand that. And I think that's why I think there's now a credit regulator that's actually out there to protect people from such predatory lending. And it's been happening. But the regulator has seen that, the Reserve Bank has seen that they need to do something to protect the consumer, because sometimes people are getting fleeced because they don't really understand these financial products. And I think that's where we come in as the people that actually educate. I'll give you another example. A lot of these providers, you're doing your bond for your house. You expect the financial provider, the bank, to give you the right premium payment every single month. But if I take out my calculator at times, I found that what the bank is charging you and what they should be charging you are actually two different amounts. So, yeah, it's something that people need to be conscious of that. Don't trust every provider. Question. You know what I mean? Talk to your financial planner at times and actually realize, okay, I'm paying so much and we've agreed to this prime minus prime plus this rate. Is this what they're really charging me? And that lack of financial education leads to some people getting fleeced even by some of our financial institutions. They don't understand how much they should be paying, and they can't question because they don't understand how the interest is calculated. So it's important to really have that financial education.
Yes, and talking about how interest is calculated and the financial education that we need, is it true? This is something I hear a lot, right? I hear it a lot, and this is not a racist remark, right? To our audience, if you are a different race. Is it true that they charge black people more interest rates than the whites? And is it true that your interest rate is also calculated based on where you live, and also based on your age and stuff like that? Because I've been told, and also the things I've also seen trying to get a car, I qualified for a quid for like 4.8, entry level quid. And I was like,
wait, what do you mean 4.8?
Per month, 4.8 per month. And that was like 2 years ago, 3 years ago. Yes, that's how much I qualified for. And I was like, I can't do that, because people are paying 6,000 rand or 5,000 rand for a Haval, right?
Yeah, exactly.
So it didn't make sense. But when I actually talk around in my circles, with people, and they're like, no, it's sometimes based on where you live, what race you are, and the age. Is this true?
So from my perspective, from my experience, they do have criteria that they use to assess what interest rate to offer something. And some of these criteria are things that we miss out on, that other, I don't want to be racial about it, that other demographics actually get to learn at a younger age. You know what I mean? Remember, for some of us, a lot of the times we get into the credit market a little too late without much knowledge. We don't have a culture of actually having financial advice and understanding what products we need to have from a very young age, right? It's very good for you, even if you have a child, to put them on financial products very early, to put them on even committed savings plans. You know, there's a tax-free, put your child on tax-free. All these small little things build their profile. That, listen, this child has been continuously paying their tax-free investment, right? By the time that child gets to an age where they now want to apply for funding, they've got a record already. You know what I mean? So it might be these habits that other people have that actually make their credit profile better, that we don't have. And yeah, we might take it sensitively, but I think the issue is mostly about financial education, understanding how to improve my credit profile, to have a record of being able to continuously pay out money on an ongoing basis.
Wow, so it's not a race thing. No? It's not a.
Sometimes it's not necessarily.
Sometimes. Sometimes. Keyword. Sometimes. Oh, I really didn't know that. You know.
I just want to check with the balloon payment thing that you mentioned before. The balloon payment is it's that lump sum that you have to pay at the end of your car loan payment period, yeah?
Yes, that's the one.
So what happens if before that ends, I want to sell my car or I want to trade it in? Do I still need to cover the balloon payment, or is it then just let's forget about it and then we just go on what you've paid so far?
And also to add on that, when I was car shopping, I won't mention any dealerships, but when I was car shopping, I was told that the reason why people can just switch cars over the years is because of the balloon payment. They can take this car, and then when the newer model comes in, they trade that in, and then they take another car because they have a balloon payment. So you mustn't take a balloon payment unless you don't, unless you won't. They said you mustn't take a balloon payment unless you plan on taking another car within the 6 years you're paying the car for.
Yes, I agree with what you're saying. So the idea for balloon payment is the fact that you're going to have an initial lower payment per month, right? So a car that would you pay 4,000 for your example, using your example there. When you have a balloon payment, you might end up paying 2.5 for that car, right? It's cheaper now on an ongoing basis. But the assumption is that somewhere along the way, you're going to have a lump sum of cash to pay the balloon payment. And usually that's through selling the car and being able to now cash in and pay out the balloon payment. And the assumption is that you can have a lump sum, and most people actually sell their car to be able to have that lump sum to pay off the balloon payment.
Oh my God, this is yes.
So if you want to keep a car, you'd rather not go balloon payment, because that lump sum required at the end is going to be quite significant, and you'd rather not do that and just have it financed properly, 100% financed, and you pay out until as soon as you're done 5-year term, there's no big payment that needs to be done at the end. You just paid off your car.
Yes, and apparently balloon payments are financiable as well. They're like, you can take a financial something on it and pay it for the next 2 years. So you end up paying a car for 7 years instead of 5, because you can't afford to give them the balloon payment at that rate. So after the 5 years, this is what I've heard.
People finance their balloon payments.
They refinance them.
That's crazy.
So see, that's the thing. What you need to realize is you've got a 300,000 rand car, right? You end up paying 500,000 for it. If you have a balloon payment, you might end up paying 700,000 rand for it, for example, simply because you keep refinancing. And remember, this is not free money. You're paying interest on this money,
100%.
Which makes it obviously expensive at the end of the term. And which is why I always say that it's always important to be a saver than a borrower, because usually with interest, the borrowers are paying the savers. So when you have excess money, right, someone who needs to borrow is borrowing from you. So that's why the bank offers you interest for having money in your bank account. But if you're on the other side and you are paying interest, you're paying someone just for just being disciplined, in essence. Literally, that's what you're doing.
So discipline is really costly. Hey, if you don't have it, you end up paying for it and not knowing that you're actually paying for it.
100%.
Wow. So, you were talking about other alternatives for debt consolidation, like how they would open a part of, you're saying a part of your salary or a part of something
Yes.
for you to have access to throughout the month so that you don't touch. Can you actually talk more on that? Can we go back on that?
Okay, so some providers, what they're saying is they realize that sometimes unexpected things come. Ideally, as financial planners, what you want is for you to have an emergency fund for emergencies, because you never know, unforeseen things do happen, right? But if you don't have a savings emergency fund, right, for that unforeseen circumstance, instead of you now going to the loan sharks, all right, to be able to get credit, some of these financial providers just realize that no, this person earns a salary every single month, right? So we know the salary is going to come, right? So instead of them paying ridiculous interest rates, why don't we just at least forward them some of their salary before the pay date? But it comes with limits, because if I give you
Your full
80% or even 100% of your salary, by the time payday comes, you've got nothing left over. So they do limit that to how much they can actually give you, so that it doesn't create a vicious cycle.
So this is company dependent.
So the people that are doing this are people that actually are doing the pension funds for you as an employee. So they have a relationship with your employer, so they know obviously what's happening in the company. They're the ones handling the pension funds. They realize that no, from an employee point of view, if an employee doesn't have funds to come to work, for example, it's going to affect the employer. So they design products to be able to assist the employees access some of their salary money before payday, so they can continue coming to work and continue being productive.
Hey,
Wow.
as the devil's advocate, I'd say the product that they must invent is to pay the employees better.
More.
Yeah, pay them more.
Pay them more,
They must
so that we don't
invent
have problems
Yeah,
going
so that we don't need the money before the month end. You know what I'm saying?
I think there you actually, have a point there, because it actually avoids, also like prevents, the person to actually be in debt traps, because it gets to a point where, how do I put this? Where when you are desperate and you don't have emergency funds, you just accept whatever. And like you said earlier, we don't know how to calculate interest rate either. So it becomes another situation. So I think that's another thing that maybe a lot of companies should do, because I don't think all the companies do, since other companies do not offer, stuff like that, packages like that. So, wow. Yeah.
No, I think what's important is for companies, even companies need financial advisors. They need financial planners like myself. I think some of them don't even know that there are products like that available, which is why it's important to have these discussions for them to understand. Because remember, the loan sharks, they're going to charge you probably 30% plus in interest. Yeah, that's how much they charge. And that's going to be a lot. And you can avoid that by just creating structures where your employees can access their salary at a sub-minimal interest rate. It's not going to be anything crazy like 30% at all. And that means they don't have to spend that much extra money on paying interest. And it gives them, like I said, an opportunity to not end up skipping work because now they don't have funds, because they've got an emergency, a child's been sick or something has happened, they didn't have the funds, so they had to use their transport money, and now employee stuck, and no one benefits from that situation.
But we've also, even though we've spoken about such, other emergencies can occur where you can actually be injured and you can't work. You can get sick to a point that you actually can't work for a long time, or you can, be held bound to a wheelchair, who knows. So what are the packages that you would actually recommend to our audience to get for such events? And also losing your job. Something could happen and you can definitely lose your job. I know getting retrenched, you get paid, but maybe something could happen and it could lead to you being fired. And between the time of you dealing with the CCMA and trying to get back, you need some form of money there. So what are the packages or some of the financial advice you give to someone to prepare for such emergencies?
So let me talk about life insurance here, because you're now going into life insurance there. So life insurance is there to protect you from unforeseen circumstances. We know life insurance is obviously death dependent. If I die, it covers me and pays out. But then there's also disability. If I get disabled, if I am sick and I'm unable to do my job, right? There's products out there that it tells you that if you can't do your job, right, there's a 7-day waiting period where they just make sure that, oh, you really
You
are
can't
sick. You really can't. But after that, they can pay you for up to 2 years, your salary. This is now the insurance company paying you your salary. And at times you'd find your employer might be paying you, the insurance company can still pay you. Simply just because you can't do your job. And that product is designed to be able to pay out if you are unable to do your job. So that's what that product is there for. They've actually designed products to be able to cover people when they are sick and unable to do their job.
So guys, do actually research those products and get them for yourself, just to be safe, because we travel to work with taxis, we travel to work in high traffic areas, and people are speeding. Anything could definitely happen, and you want to be protected financially when those things happen. And also, can you tell our listeners how can they spot a proper financial advisor, like someone that they can trust with their money? Because for some reason someone ran away with my sister's money and I don't understand what happened there, and it was supposed to be financial advice.
No, I hear you. I think
he needs to have a suit. His business cards must be laminated. He needs to introduce himself in Model C English. I'm kidding. Go ahead.
all right. So remember, there's 2 types of advisors. Let me just be clear with the viewers out there. There's insurance salespeople. They're just there to sell insurance products. And there's financial advisors. They actually took the time to go to school to learn about, obviously, what finances are. I'll give you myself as an example. My undergrad degree, I studied economics and finance to understand, obviously, how things work in the financial world. And with my honors, I did financial planning. When I did financial planning, I had to understand things like the Marriage Act, as an example, so that when you get married, you need to understand the implications of getting married. Because, if you get married to someone who's not financially disciplined and they are bankrupt, and you are married in community property, you are also bankrupt. You know what I mean? So all of that information I had to learn. And understand that to advise you, I need to understand the law, and that's what a financial advisor does. So you need to have a conversation with them, understand what they invested in their craft, if you know what I mean, and from there, then you know that they're capable of what, of giving you advice. But I'm a financial planner. I had to go through an honors level degree. I had to do a 6-hour board exam and to be able to call myself a certified financial planner. And for that benefit, I get to be a commissioner of oaths. I can certify documents, I can oaths and all of that, I can sort that out. And that is what I invested in my craft, to be able to actually have conversations with my clients and give them value. And so for you to actually work with someone who understands what they're talking about and has invested in their craft, you need to ask the right questions. What have you, what qualifies you to advise me, for example? You need to ask that question so that they tell you what they have invested in their craft to be able to give you appropriate financial advice.
But also, how can you verify that? Because, I know with the doctors, there's like AC, please correct me, there's like a website where you can go type, right? Yeah. And check, right? Is there like a place where you can go type and check the financial advisor if they are, or do you have to go maybe to their company, the company website where you can check if the company is registered, legitimate, all of those things?
Okay, so what usually happens is for financial advisors, a lot of the times they have what they call disclosures, where if they're working with a big insurer, the insurer does the due diligence, and every time an advisor sits down with you, they have to give you a document that outlines what they're qualified to do and what they can't do. That also gives their qualifications and all of that. That's for the big providers. I'm talking about the big insurance companies. Then there's the small guys that obviously those are a bit.
With the hoodie.
Those are a bit suspect. You just need to do your due diligence. I think sometimes you just need to ask the right questions. Like I said, it's about ask difficult questions, right? That if someone doesn't understand, they're going to trip over themselves. You know what I mean? Because you know what you want. I mean, obviously, you might not know how to articulate it and explain it clearly. But if I sit down and say, okay, I want to be financially independent in so many years, what is it that why you? Why should I work with you? And from there, I think you can get an understanding of the person's competence. You know what I mean? Because a lot of the times, we just want them to give us something, but we don't ask them, what is it that you can do for me? Why should I listen to you? Very important to ask those questions.
And do financial advisors work like on a retainer, or is it like a ad hoc basis where when I need one, I call one?
So we've got different structures, right? Some advisors actually get their money from so let's just say I recommend a product to you, right? When I implement that solution, I get money from the provider. So I don't get money directly from you. I get money from the solutions providers. That's one. Others actually charge you for their time. So I'd give you my hourly rate, and I'll tell you that I need to work so many hours to do a financial plan for you. So I'll charge you just my time. So all the products and everything, I won't charge for anything for that. So we have different kind of structures. And usually for the lower end of the market, it's best to work with people that actually get their money from the product providers, because you're not paying directly to the financial advisor. You're going to get the incentives from the insurance company, bank, whatever financial institution that they're working through to implement your solutions. That's how they'll get their remuneration.
Wow. And actually, before we actually close, let's go back to the Marriage Act so we can advise people, because people actually have a general conception, a misconception that getting loboled, you're not fully married. And they don't know that if you get loboled without a prenup or antenuptial or post those kind of contracts, I would love to say them, but I'm a designer in life, guys. I deal with colors. So, they don't know that if you get loboled and there's no agreement in place, you guys are automatically married and coming to property. Does that mean at that state, if my partner is broke, like you said, I'm broke too?
Yes. Sorry. In essence, yes, it does mean that. So what I would say, right, is before you make any critical, life-changing decision, talk to someone who understands these things, right? Talk to a financial advisor. Talk to a financial planner. I'll give you another one outside of marriage. People go out on social media, post these fancy cars. I got a expensive car from my boo, my bae, my what. SARS is out there actually monitoring these things, hey? And people get themselves in trouble by simply trying to floss and post things. Because what happens is, according to law, if you get a Range Rover, whoever gave you that has to pay 20% of its value as donations tax, right? If they don't do that, it means that there's a problem. And also, if they buy you a Range Rover and they've got no proof of funds, where did this money come from? SARS can come and say, but how come I looked at your returns? You're making this much money. And then, so how did you afford this Range Rover, for example? So there's a lot of things people are doing on social media, exposing themselves, not understanding the fact that, no, there's a team actually out there on social media scouting to see who has
so like their daily
purchases.
Job is just to sit on Twitter, Instagram. Yes. That's a cool job, just to sit and be like, this is too fancy for you. When we check, it doesn't correspond.
It doesn't make sense. Exactly. So there's a lot of,
even with the houses as well, it's also done the same way.
Yes, you gotta prove that I earned enough money to purchase this property. So that's what I'm saying. There's a lot of things that we don't realize the consequences. But it's always important to talk to a financial advisor to really understand the consequences of these actions and not get ourselves in trouble.
Okay. Just one last question, right? If someone wanted to get into like a financial advisor role, is it something that, the job market that is growing? Because, we have a high rate of youth unemployment, and we're also trying to make sure that the current matriculants or the current young people know which courses to study and know which courses are in demand. So do you think it's a great space for people to come into it at the moment, for the young people to actually study?
So I'll tell you what my lecturer in second year at Stellenbosch told me. At that time, I think that was 2008. Yeah, I'm exposing my age a little bit there. But what happened is, he told us as a class that, listen, financial advisory industry is, the average age of an advisor is 55 at the moment. And they are about to reach retirement. And the industry is lacking young people. So they actually introduced the financial planning program when I was in my second year, which is why they were pitching it to us. And they encouraged us as young people to actually do it. And what I've realized that I followed that path gladly, and there's a lot of job opportunities for us simply because, as you said, a lot of people don't have savings plans. They don't understand. There's no financial education in essence, and it's a big need. And as a result, there's a lot of opportunities, and you'd find the complexity of finance, even the language they use at times, it's meant to confuse. It creates a high barrier to entry. So there's a need always for financial advisors. And with all the changes to pot, all these, there's now, even in retirement space, they need people to be able to help people there, and even from all these. So there's a lot of opportunities in this space. And you need to consider it as a very good career direction to take. But it comes with these complications, because for you to be a good financial advisor, you can't be someone who can't manage your own money.
Oh, yes.
So your credit rating has to be on point.
Correct.
Right? And if you've got a criminal record, you also can't be a financial advisor.
Because we're not going to trust you with our money.
100%.
Oh, yes.
So I can't be a financial
Yes, you have a AC. So guys, that brings us to the end of our show. I think we're definitely going to have Raymond back, because there's a lot of things we need to unpack. I did not even know there was a marriage act. So guys, when you marry carefully. But other than that, there's a lot we've learned, and students who are actually looking for courses to study that are high in demand, consider financial advising, consider financial planning. But that brings us to the end of our show. Thank you so much, Raymond, for coming to our show.
Thanks for
almost said yes. I almost said your line for you. And we're gonna put his contact details below if you are looking for a financial advisor or financial planner. He is definitely the right person to actually assist you. I think this is his entire pitch to you. So definitely, guys, and please don't forget to follow us on social media platforms at Z Podcast 1 on all social media platforms. Thank you very much, and we will see you next time. Bye.